Good morning, ladies and gentlemen. On behalf of FSM1.com, I extend a very warm welcome aboard to ETF Festival 2021. This year's ETF Festival theme is Explore and Take Flight. With the COVID-19 outbreaks and travel restrictions, I'm sure many of you miss traveling. Fret not, as FSM1.com will bring you on a virtual flight around the world with ETFs. We have an exciting lineup of presentations today categorized into pre-flight checklist, in-flight and destination segments. We will be helping you through your ETF journey from pre-departure preparations to landing at your destination safely. On our flight today, look out as we share with you about ETFs and how to invest in them. We'll also share about the ETF focus list and discuss pertinent topics such as whether fixed income ETFs should be your portfolio's life jackets and how you can invest in the ever-important sector that makes up your in-flight entertainment. Of course, flying is not the only thing we're doing. We'll explore some destinations with you by covering various specific ETF sectors of interest, including our very own China Hour. During our lucky draw today, 5 lucky participants will walk away with $100 worth of Quiz Shop vouchers, and 1 lucky winner will receive the grand prize of $880 worth of FSM1 multi-currency cash account credits. All you have to do is to attend the ETF Festival and collect chances throughout your day. You can accumulate your chances by logging in. You can also accumulate chances by participating in the quiz sessions, or completing and submitting the survey today. Or you can also visit our partners pages and by sharing this event on your social media through the social media buttons on the footer. To receive the chances, do ensure you always use the same ID and email address when logging in. At the end of each segment, you can also take part in our quiz. There will be 3 quizzes held today, and the top 3 participants from each quiz will each receive 3 units of the Away ETF MG Travel Tech ETF. As we gear up for the start of the sessions today, we would like to kick things off with a poll. To participate in the poll, firstly, click on Event Activities on the menu below this video. Under the agenda, look for poll number 1. Then click on the Join Poll button. And the poll window will be displayed on your right. Poll question number 1, do you miss traveling? I think we all know what the answer to this is. "45% of us miss traveling a lot, and only 27% of us kind of miss traveling. And the rest of us are just happy to have more money to invest." Question 2, which markets or sectors are you most bullish on? The majority of us are most bullish on the US technology sector. Question 3, how much investing experience do you have with ETFs? Have you been investing with ETFs for a very long time, have some exposure to ETFs, or you recently started investing in ETFs? Or are you not very sure what ETFs are? Looks like the majority of us have some exposure to ETFs, but some of us, 7% of us, are still not quite sure. That's what today's festival will be helping you understand. Question 4, have you taken advantage of the 0% processing fee promotion on ETF regular savings plans? "58% of us have not started but are thinking of starting." Thank you so much for participating and sharing your thoughts with us. And with that, let's prepare for takeoff with Jean-Paul Wong, General Manager at FSM1.com Singapore. Jean-Paul will guide you through on what you need to pack as an investor to get ready for your investing journey.
Good morning, ladies and gentlemen. Welcome to FSM ETF Festival 2021. This is the third consecutive year we are organizing the ETF Festival, and we hope you'll enjoy today's session. Our team of analysts and investment advisors, together with the partners from the ETF industry, have prepared a number of presentations and panel discussions touching on the ETFs that should be on your radar. Today, I'll be running through some of the ETF trends we see among our investors and talk through some considerations you can adopt when building a simple global portfolio. The ETF universe is huge. We're talking about over 3,000 ETFs for us to choose from. So having a way to zoom in on those that matter is really important. This is why we have the ETF focus list, which narrows down the list of ETFs for you to just 50 plus. Our research team reviews it every year, and later on, our analysts will be sharing more with you on the new ETF focus list for this year. We also introduced the ETF Regular Savings Plan, or RSP, to make it easier for you to invest from just $50 every month. The usual commission rate is low, but what we have done since January this year is a 0% commission rate, and we're extending this to December 2021. The role of the ETF focus list and the ETF RSP list are like signposts along our investment journey. It gives us certain direction on what to do. Today, our investors can trade in ETFs on the US, Singapore, and Hong Kong exchanges. In the last 3 years, we have seen an increase of over 10 times when it comes to ETF buy trades from our investors. We are thankful for your support, and we will continue to work hard to provide useful tips and new services along your investment journey. So far this year in 2021, when we look at what our investors have been buying into, it's been a wide range of ETFs. The usual popular ones include our local STI ETF, our Singapore market, as well as the US S&P 500 index. But our investors are also investing into quite a variety of ETF destinations, including the likes of Hang Seng Tech, which is a more recent ETF newcomer in the marketplace, which is the Chinese tech companies listed on the Hang Seng Index. We also have investors buying into the global internet giants, which has become a very important theme since last year because of the pandemic. And we have also a number of investors looking into the various ARK ETFs, including innovation, but they also have the genomic revolution and fintech innovation that's been quite popular. Some of our investors have liked semiconductors. It's been a sector that our research team, we've been talking a lot about why we like it for quite a while. And the more gung-ho investors have even gone for the leverage ETFs in the semiconductors as well as other sectors. Among other sectors that have been popular this year so far are gold, silver, and clean energy. So I think with ETFs, it's really easy to travel the world because they offer really a niche exposure for us in a very easy manner. So I'd like to share 4 points today based on some of the trends we see. First, on the asset allocation. It's important for us as investors to see if our portfolio is into just one type of asset class or not. Very simply, we look at 2 main types of asset classes. So these are equities and bonds. And we talk about these two because historically they have a low correlation with one another, which is a good thing for diversification purposes. So it looks like a number of our investors, when they buy ETFs, they've been going quite a bit into equities ETFs. So I think not too much of a surprise because equities have done so well last year, especially after March. So it's good to review and see if there's room for more bonds because that's what provides extra cushion and lower volatility when global markets go through their ups and downs. So when we look at markets, I think it's we can look at it as some form of turbulences every now and then happening when markets go through wide gyrations. And I think that's where bonds are coming into place and can provide some cushion for our portfolios. So one easy reference point would be a simple balanced portfolio that has about 50% in equities and 50% in bonds. And from there, you can then adjust your asset allocations depending on your purpose of investing, the kind of risk you're comfortable with, and the time that you have on your side to be invested. But no matter how aggressive you are in terms of risk tolerance, we always advocate not 100% in equities, but to have at least 10% of your portfolio in bonds, because that can help to cushion the market volatility and the turbulences along your investment journey. So one very simple example for Singapore-centric investors, so for those of us that look at our investment portfolios in Sing dollar terms, our Sing dollar corporate bonds ETF would make sense. If we want a little bit more uplift in terms of the yield that we can be looking at, a Chinese government-centric bond can also be an interesting addition. And for investors with a bigger risk appetite, an Asian high-yield bond would also be an interesting addition because of the higher yields, but of course that comes with higher volatility as well. So the local home bias is my second point today. We are more familiar with the Singapore companies, obviously, because we grew up with a lot of the Singapore companies and the brand names, and we use them in some ways in our daily life. And this explains why many of us have exposure to the STI. But if that's the only holding in your portfolio, it's not going to be enough to achieve our long-term goals. The reason why I say that is simply because we need to have exposure to a more diversified portfolio that is exposed to global trends and catalysts. So for instance, adding a global equities fund exposure would do the trick quite quickly if we want to build a more global portfolio. From our chart center, which I have on this slide, you can find that this example here, which is from Vanguard, which is called VT, it did about 42% in the last 1 year on a total return basis. Of course, the timing matters because that performance in the last 1 year took into account the start of the bull run after March 2020. So of course, do look into the performance numbers over the different time periods as well as the volatility. And from the ETF top 25 holdings information on our website, you'll be able to find also that this ETF is exposed to the major global companies from the US and China. I also want to talk about the core and supplementary portfolio here because I think a lot of us, when we look at some of the ETFs that our investors have been buying, a lot of them are into the more niche sectors. So these are what we call the tactical ideas that we like, and those have done generally pretty well if you're exposed to a lot of the sub-tech sectors last year, for example. And I gave a few examples just now of the Hang Seng Tech as well as even the other sectors like your disruptive innovation and so on. The point here is that your tactical ideas, and I have this slide here, is to keep it within to a smaller proportion of your portfolio. We call it the supplementary portion. And the simple reason for that is we don't want to have a portfolio that has 100% exposed to all the exciting tactical sectors. And that's really simply because it's really volatile. So having a little bit of your portfolio into tactical ideas under supplementary, let's cap it at about, let's say 20% would be a good idea. And the rest of the portfolio should be in the core ideas, which are invested in the dominant regional markets of the world, or even a team like Disruptive Innovation or China, which deserve a core position in a portfolio because of their growing importance, especially in the last few years for China, and also in a post-pandemic world for disruptive innovation. So I'll move into this last point here, which is to use our ETFs to give the takeoff that we want for our portfolio. I think when we invest, it's important to look at the life goals that we have. Are we investing for retirement in 10 to 15 years? Are we investing for our kids' education in the next 20 years, for example? That gives us an idea on the asset allocation and the risk we can take. So at FSM1, what we try to do is to provide various ideas in terms of research ideas. Our research team writes articles on the various ETFs, on the ETF ideas. Our partners from the industry also talk about the various interesting markets and ETFs under the ETF Hub. So you can find all this on our website. So it's a good source of ideas on what to do with markets, changes in the global economy, and the turbulences that we're experiencing every now and then in the global markets. We also have tools such as the ETF Selector that can show us the performance and volatility of the different ETFs. I mentioned the ETF focus list, so that narrows down into the core tactical ideas and the different asset classes, which I have mentioned just now in terms of how you can build a portfolio. So one key strategy to keep ourselves very disciplined and not emotionally affected by the market turbulences is the regular savings plan. I continue for myself to keep a number of RSPs in my portfolio, and we'll continue to make it easy for our investors by extending the promotion of the 0% processing fee for all ETFs to the end of this year. So for investors who invest into ETFs and stocks on the SGX exchange, our local stock market, we have also a permanent commission rate, which is a flat rate of $8.80, which helps your investment portfolio to soar higher in terms of savings. So with that, I've come to the end of my presentation. Thank you so much for your time. Stay healthy and enjoy the rest of the FSM ETF Festival.
Thank you, Jean-Paul. Our next speaker is Ong Zi Yang, Senior Analyst, Macro Research, IFAS Singapore. Ziyang will be sharing and guiding you to 3 destinations where your investments can potentially have a fruitful return. Let's welcome Ziyang.
Hi, morning ladies and gentlemen. Welcome to the FSM ETF Festival. Thank you for taking your time to tune in today and joining us here. I'm Ziyang from the Macro Research team, and today I would like to share with you the top 3 destinations that you should be looking at into investing heading into the second half of this year. Let me start by sharing on the current macro backdrop. The COVID pandemic continues to be the biggest headwind facing global equities. Chart on the left shows that the COVID cases continue to rise globally. Europe had a massive resurgence in the COVID cases in the first 3 months of this year, before passing the baton now to India and Southeast Asia, where the pandemic is still raging. This has delayed the anticipated reopening around the world, pushing back the timeline from first half, possibly to third and fourth quarter this year. Despite the delay, like many investors, we are hopeful for the global recovery ahead. The pace of vaccination is picking up rapidly across developed nations, even though it's more challenging for developing countries in terms of vaccine availability and distribution. However, I think it's worth noting that the global economic backdrop has been improving across the year. We believe we are now in the early phases of an expansion in the new economic cycle, and we could be looking at rosier days ahead. The chart on the left shows that economic reading across the world has been better than expected since July last year, not only showing signs of resilience, but also signaling that the economies have normalized a part of the negative effects of the COVID lockdown. While the chart on the right shows that global export growth of major exporters like China, Asia, US, and Europe has rebounded firmly into the expansionary territory. Part of this cyclical recovery was supported by the fast rebound in global trade activities, since they are less affected by the lockdowns compared to service sectors like tourism and travel. Here, I've prepared a chart of the Global Composite Purchasing Manager Index, which is in short PMI, where below 50 indicates a contraction and above 50 indicates an expansion. We can see over the course of the last year and this year, most economies have recovered from the deep contractionary phase of the low 20s between March and May last year, towards the high 50 across this year. In fact, global PMI has recorded an expansion of 10 consecutive months, highlighting the acceleration of the global growth momentum. Sentiments in the developed markets has improved significantly as well, with US and UK now hitting over the 60 marks, thanks to their higher vaccination rate, while only a handful of EM, like the Brazil, has sunk back into a contractionary phase. As a result, we believe the global economies are now back on track for massive growth recovery in 2021. The record levels of fiscal and monetary stimulus, alongside a low base effect, is set to drive a sharp global GDP growth this year, before moderating in 2022. Special attention should be paid to Asia and China. Not only did they avoid a contraction like the rest of the other regions, Asian growth this year is set to match that of the global growth, while China is set to hit the highest growth rate among major economies this year. The rosier outlook, due to the shift in macro backdrop from a recessionary to expansionary environment, also encourage investors to rotate into cyclical value sectors like your financials and industrials that has been beaten up heavily last year. In fact, the value rotation was actually in full effect since November last year. Here I divide the timeline into 2. Before 6th of November on the left, and on the right after the 6th of November. And why the 6th of November, if you ask? It's actually the day whereby Pfizer and BioNTech announced a vaccine candidate that is 99% effective in fighting the coronavirus. And on the left, you can see that China has outperformed the global equity market due to this better COVID management. Then in the chart on the right, once the vaccine was announced, China was quickly abandoned by investors in exchange for the laggard US and European market. And this is more obvious after February, after US and Europe trended upwards on better than expected economic data and faster pace of vaccination, while the rest of the other markets traded flat on concerns of vaccine availability. The value rally was also supported by rising inflation and growth expectation, particularly within the US itself, where inflation expectation rose to more than 2.5% in the latest reading. That typical of a pre-pandemic level. The chart on the right also shows that the value outperformance over growth has widened to almost 20% since November, outlining aggressive value rotation among global investors. Yet, we see that global investors are quickly pricing in the rosier growth outlook as well. In a way, valuation is growing increasingly expensive on an absolute level. Almost every major market on the left, you can see, is trading now way above their 5 years average level, making it a little bit harder for investors to sieve out value picks amongst global equities. But the saving grace is that the chart on the right shows that global equity markets are expected to see a massive double-digit EPS growth rebound this year, which can help bring down the price multiples as earnings gradually be revised upwards. So, after a long way around the world, this brings us back to the question, which market should we be looking at, or destinations that investors should be paying attention to heading into the second half of this year? And first up, we have Europe. And why Europe? For investors who are unfamiliar with Europe, it is a developed market with a value cyclical tilt, meaning that its equity market is highly sensitive to the global growth prospects, represented by the Stoxx 600 benchmark index. On the geographical level, the chart on the left, you can see that Stoxx 600 is well diversified across European countries, as well as having representation across small, mid, and large cap companies. On the sector level, the chart on the right, cyclical sectors like your financials, your industrials, your materials, together account for more than half of the index, which is also the reason why Europe exhibits such a cyclical value tilt. And even though the Eurozone economy sunk into a recession in Q1 this year, we think Europe is set to benefit from the strong growth momentum in the next 2 quarters forward. The chart on the left shows that Europe's economic readings have been exceeding their expectations since July last year. And if you look at the chart on the right, it shows that confidence in major European economies like Germany, France, Italy, and Spain are returning back to levels seen before the pandemic. And because of Europe's cyclical tilt and the kind of sensitivity to global growth prospects, we're actually quite optimistic on European equity for the next 3 to 6 months. In our view, there are actually 4 reasons to be hopeful. First, Europe is set to benefit from the stronger growth momentum. And if you look at the PMI heat map for manufacturing on the top, they are now in the high 50 to 60s across major European economies, meaning that manufacturing activities are set to be even better in the next upcoming months. Service PMI at the bottom, which has been largely impacted due to the COVID lockdowns, has since climbed back to positive territory for the first time since the second lockdown in Europe. The rosier backdrop is expected ahead. It's also going to be good for your earnings growth for European equities. Combined with that continuation of your value cyclical rotation, the upcoming reopening among European economy meant that investors' pessimism for Europe may be shaken off. Ultimately, this means that investors may be positioning for Europe ahead, which will drive prices up quickly in the short run. Secondly, we believe Europe will benefit from the continuation of the positive earnings revision. Earnings release since the first quarter has been largely better than expected, driving significant EPS revision just the first 4 months of the year. A closer look under the hood confirms that on the chart on the right, that they are attributed to cyclical industries such as mining, energy, automobile, banks, and financials. As you can see, that not only for investors, your commodity prices have been rising up, your interest rate have been picking up. So these businesses that were badly affected due to the sudden halt in economic activities due to the lockdown last year is starting to reverse their fortune as global economy starts to reopen. Overall, Europe presents a strong near-term choice for exposure to the global value rally, especially in the near term. We believe Europe will be a major beneficiary of the global reflationary environment, not unlike what we have seen in European equities so far. The rally will also be supported by the massive cyclical recovery in earnings of 53% for this year, as well as 15% for next year, which empowers by your cyclical sectors, which account for 65% of the index. With Europe moving by more than 10% so far, half of our upside has actually been actualized. So looking ahead, it appears that it only has about 10% left. However, if you think about it, Europe is shaping up to be one of the clear winners of the value rally, pending its economic restart in second half of 2021. We believe the market is likely to be pulled closer to our target price, possibly fully pricing in that target price by this year itself. For investors looking to gain exposure to this cyclical tilted market via an ETF, you can actually easily do so via the Vanguard FTSE Europe Index ETF at a low cost of just 8 basis points. Next, talking about potential winners of the value rotation heading into second half of 2021, our second destination naturally is also one of them, which is the emerging markets. For investors unfamiliar with the region, the emerging market consists of markets from the developing second and third world countries. In terms of investable universe, the chart on the left shows that the EM index is heavily weighted towards Asian markets like China, Taiwan, South Korea, and India, leaving a non-Asian market like Brazil and Russia a minor representation in the index as well. On the sector level on the right, the chart is actually pretty similar to Europe, where it's heavily weighted towards your cyclical sectors like your financials, industrials, materials. But it also has a fair share of exposure to growth sectors and long-term growth trends. Growth sectors such as IT, communication services, and consumer discretionary account for more than 50% of your ETF EM index, with high-quality internet heavyweights like Alibaba, Tencent at the helm of internet companies, and world-class chip makers like TSMC and Samsung at the helm of the IT sectors. Even though performance has been quite strong in the first 2 months of the year, EM index has started to struggle after mid-February, partly due to the sudden strengthening of the US dollar. The chart on the left shows that the EM equities have historically traded quite closely with dollar trends. In other words, a strong dollar is quite bad for EM equities, and vice versa. A weak dollar is great for your emerging markets. Therefore, the direction of the US dollar plays a major role in the momentum of the EM equities, which we think is likely to head further downwards ahead on a mid to long-term trend. The chart on the right shows that US, the high twin deficit, this time caused by its massive fiscal stimulus package, which Biden has announced in February of 1.9 trillion in USD, as well as a lot of his quantitative easing program, in other words, money printing, has always ended up in a US dollar downtrend. And we think that this time, it will not be any different. Besides the twin deficit, there are also other factors weakening the dollar. First up, the potential for a strong euro pending its economic restart is likely to weaken the dollar, given that Europe makes up almost 60% of the dollar index. Part of the dollar strength was also due to the upgrades to the US GDP growth after its recent impressive economic data and fiscal stimulus. However, we do see a case that emerging markets to close out the growth differential against the US in the latest part of this year, especially when vaccination drive catches up and broad reopening to open up for the world, especially particularly your Asian ones. If you look at the diagram on the right, our current macro backdrop, the synchronized global recovery, so slowing US growth on the long term, your lower real interest rate actually favors a weaker USD, which will in turn be supportive of emerging market equity prices ahead. And the point is the same as Europe case, where we see that cyclical EPS recovery for emerging market remains well underway, supported by a steady rise in commodity prices since the mid of last year, as shown from the chart on the left. The chart on the right shows you that, interestingly, EM equities actually trend closely with the growth of commodity prices on a historical basis, back all the way since the 2008 great financial crisis. One reason could be that the rising commodity prices typically indicate that global manufacturing activities are continuously expanding steadily, which is good for manufacturing-reliant emerging markets like China, Taiwan, South Korea, and India. At the same time, the rising commodity prices also benefits the commodity exporters like your Latin America region as well as Middle East region for their oil and metal, although representation is slightly more minor. With commodity prices continue to ramp up steadily this year, we expect that earnings for EM to continue revise positively ahead. Third point is that the valuations are subsequently knocked down to fair both on this year as next year's forward PE multiples, looking at the chart on the left, thanks to the combination of a rising growth prospects as well as the recent correction in the EM equities. We think this should alleviate any investors' concern of a frothy valuation within the emerging market itself. At the same time, the chart on the right shows that the valuation resets have widened the kind of value discount that emerging markets has typically against the developed market. EM equities now trade close to 30% discount to that of the developed market, where the discount typically average only at around 20%, meaning that value-seeking investors are likely to rotate into the EM soon to take advantage of its cheap valuation now. Overall, we remain highly constructive of EM equities despite the recent correction. We believe the combination of a fair valuation alongside the strong double-digit EPS growth, supported by 5 catalysts, with good likelihood of materializing, like your commodity upcycle, as well as your synchronized global growth. We believe that EM equities, your emerging markets, stands a good chance to outperform global equities this year. Although our projected upside of 25% is for end 2023, based on our calculation on the upside potential table on the top left, we won't be surprised if the market actualizes more or most of all of it by the end of this year. We believe that EM remains an alluring option for investors seeking to take advantage of the cheap valuation for exposure to the global value rally. Investors seeking exposure to this broad EM market should also do so via the Vanguard FTSE EM Index ETF fund. Next, we come to the last destination of the day, which is a single market within the EM space, China. Investors who have followed us for a while may protest that why are we pitching China as the third choice again, despite its poor performance after February this year. China has fallen by 25% from its peak in mid-Feb. But there's a reason why we remain optimistic in China. So you have Europe, which is highly cyclical tilted. Then you have the broad EM index, which is a good mix of cyclical and growth play. On the other hand, the makeup of China Equity Index is actually highly growth-oriented. Internet e-commerce companies like Alibaba, Meituan, and JD dominates the consumer discretionary sector, while Tencent, an owner of messaging app WeChat, and the gaming companies NetEase dominates the communication service sector. And looking at the charts on the left, you can see that chart on the right, you can see that the sectors account for more than half of the index weight. Such outsized exposure to growth and internet sector was a boon for China equities within the global lockdown backdrop of last year. But China has become a victim of its success this year. We believe that part of this weakness at this point of time in China comes from investors taking profit of their winning position and rotating their gains into cyclical value-oriented markets, given the kind of excitement for a global reflation this year. At the same time, 2 other risk factors has emerged for China. China's deleveraging drive, as well as its tightening regulation on its mega internet firms. Yet, we think that the concerns have been priced in and will likely ease over time. And I will explain this over the next few slides. First of the two concerns is that China's possible hard landing, particularly as policymakers look to reduce financial risk after the much publicized Huarong debt crisis. China's strong rebound in economic activities, coupled with concerns with its rapidly rising real estate and asset prices, should enable the Chinese government to continue to focus on deleveraging and possibly tightening of monetary policy ahead. Based on the chart on the left, this is actually quite evident from the sharp drop in credit impulse across March and April. But if you look at the chart on the right, economic readings have largely been in line with expectations, signaling that the V-shaped recovery in the economic activities within China remains well underway. And part of the confidence comes from the fact that the first set of the economic prints coming out from China at this point of time has been quite promising, even though the surprises are more muted compared to the massive expectations beat within the US and Europe at this point of time. Therefore, it's also clear that investors will be comparatively less excited about China equities at this point of time. But we argue that China growth can continue organically without any further stimulus, sort of nulling any concerns for its restriction in credit growth, and that the economy is on a steady footing to meet our GDP growth expectations this year. The second concern investors have for China equities was that the China government has tightened regulation on tech players like Alibaba and Tencent. While investors' worries are reasonable, we believe that the negative development has largely been priced in already. The chart on the right shows that the divergence in performance between China internet giants versus its EM peers has widened significantly since then. With those negatives already factored in, we believe investors are neglecting the strength of the internet giants. A majority of them already achieve critical mass and are actually benefiting from network effects, enabling them to provide superior products compared to their smaller competitors. At the same time, these tech giants are crucial to China's 14th five-year plan to digitally transform its economy. Facing steep competition from US tech counterparts, we believe China will likely show restraint in governing them, and their intention will be mainly to increase oversights to this fast-growing mega industry that has become a crucial component of its economy. The subsequent sell-off in China equities after mid-February has actually knocked valuation back below our fair value of 14.5 times, skimming away the froth within the China equity market, as shown on the chart on the left. We believe the reset to valuations should allay any concerns of overheating within its equity market, given the strong performance of China tech players last year, and also provide a cushion for any further downside risk within the China equity market. The chart on the right shows that the relationship between China leading indicators and its underlying EPS typically is actually quite strong. And at this point of time, what we are seeing is that there's a sharp bounce within its leading indicator index, meaning that earnings is likely to be quite robust, and we project to be a robust double-digit growth this year as well as next year, which will be vital in driving a healthy expansion within China equity market ahead. While we can understand why investors are understandably concerned about Chinese policy intervention in financial deleveraging and tightening of regulation, we believe that the economy is on a strong footing to meet our growth expectation this year. And the promising economic data year to date also indicates that the V-shaped recovery within economic activities in China continues without even as the policymakers restrain the credit growth. And with valuations now reset to a healthy level, coupled with that robust double-digit growth, we continue to iterate a very highly attractive recommendation for China. Our projected upside looking ahead for China is more than 30% by end of 2023. And we see that recent pullback in China a buying opportunity to accumulate growth exposure to high-quality internet companies like Alibaba, Tencent, and Meituan on the cheap, alongside your cheaply valued China Big Four banks in your MSCI China index heading in the second half of this year. investors who believe that the value rotation that everyone has been so optimistic about, which have maybe been overdone, and believe that the growth kind of trends are due for a comeback ahead, can actually access this growth theme via the iShares MSCI ETF index. Where there's actually a large overweight towards more growth-oriented sectors such as your technology, consumer discretionary, and consumer communication services. With this, I come to the end of my presentation. I hope we can give these three top destinations. On one end, we have Europe, which is value cyclical tilted, followed by emerging markets, which is a good mix of value and growth. And on the other hand, we have China, which is largely growth-oriented. These three destinations should be given a good consideration when choosing where to invest in the second half of this year. That's all for me now. Do stay tuned and enjoy the rest of the other presentations that we have prepared for you today. Thank you.
Thank you, Ziyang. Now that you have heard from the iFast Macro Research Analyst, you may have an idea what areas you would like to invest in, but how exactly should you go about doing it? In our next presentation, Catherine Chua, Assistant Manager, Investment Advisory, FSM1.com Singapore, will be sharing with you about embarking on your first ETF investment. From how to kickstart your ETF journey to the recommended approaches of investing in ETFs. Catherine, please.
Thank you, Geraldine, for the introduction. So my name is Catherine, and I'm from the Investment Advisory team. So today I'll be sharing with you some of the basics to investing in ETFs. So let's get started. So if you're new to investing, ETF stands for Exchange Traded Fund. Do you know that the first ETF was introduced almost 3 decades ago in 1993? So what are they? Basically, they are a portfolio of investment products such as stocks, bonds, and money market instruments, etc. ETFs can be traded like a stock on the exchange, and you can trade them intraday, like buy and sell, make profit. So most ETF out there are passively managed by the ETF managers, and their main aim is to replicate the performance of the underlying index. As the fund managers do not cherry-pick the investments within the portfolio, they invest accordingly to its securities weightage and the composition of the index. As such, in absence of such an active manager, the expense ratio is also typically lower compared to actively managed funds. Investors also get to enjoy greater cost savings because instead of buying into the top 30 companies on the Straits Times Index, they can invest in just a single ETF which tracks the Straits Times Index and gain exposure to all the components of this index without spending a bomb. So ETF offers high transparency as investors can see all the securities within the portfolio as the ETF are required to publish them on a daily basis. So do you know that over the last 28 years, the ETF industry grew its total asset under management to over $7.7 trillion US. So before we start investing, there are some factors which we should pay attention to, and I will elaborate more over the next few slides. So the first and one of the more important factors to consider is the ETF expense ratio. This ratio is expressed as a percentage of the fund's operating expenses to its total assets. The lower the fees, it translates to a higher return to you. So it is important to compare the ratio within similar asset classes and markets. So for example, I've shortlisted these 3 ETFs that are more commonly used to track the performance of the S&P 500 index. They are from Vanguard, the stock code is VOO, iShares, the stock code is IVV, and from State Street, the stock code is SPY. In this table, you can see that the Vanguard and iShares have a more competitive expense ratio of just 0.03, compared to the State Street, which is 3 times higher at 0.09. So ideally, an ETF should mirror its index perfectly, but there are a number of reasons why it prevents them from doing such a mirror image replication, such as this difference is called the tracking difference and the performance between the ETF and the underlying index. So this problem exists mainly because of like fees incurred from operating expense of the funds, transaction, rebalancing costs, representative sampling, hedging costs, etc. So the wider the difference, it means that the ETF is not tracking its index as efficiently as its peers. So if you were to look carefully at this table here, I've shortlisted again the same three S&P 500 ETF, which are VOO, IVV, and SPY. I've charted them against the S&P 500 index. So if you were to compare the difference between S&P 500 benchmark, the SPY ETF shown on the third row actually shows a wider tracking difference of 3.4% compared to its peers. So typically, you can also download the ETF fact sheets from the product provider's website, which often shows the tracking difference between the ETF and its underlying index. So ideally, we will want to select an ETF with the smallest discrepancies against the underlying index so that it can duplicate the performance seamlessly. Yeah, so moving on to the next factor, knowing the underlying index which the ETF tracks is important. This is because the index would tell us its constituents and which asset segments or markets it's trying to replicate. Each index has its own selection methodology, which is the rules that determines which assets will be included or excluded from the index. As such, your monies will be invested accordingly to the index composition and impact the overall investment returns made by such an asset allocation. So, for example, over here we are looking at the Straits Times Index, STI. This is a market capitalization weighted index that tracks the performance of the top 30 companies listed on SGX. But do you know that 3 local banks actually takes up 42% of the index itself? That means that for every $100 that you invest in the STI ETF, more than a third of the portfolio is actually invested in the financial sector, and hence concentrated within the 3 local banks. So understanding the underlying index will shed light on the types of the securities you are exposed to and if it's concentrated or diversified enough. So for ETF to replicate the underlying index, they can either use a physical replication or a synthetic options. So physical ETF means that the funds invest directly and hold securities that makes up the index itself. But sometimes due to liquidity constraint or large numbers of holdings in the index, the ETF might do a partial replication instead. So the ETF holds a selective basket of index constituents that best represents the index itself. So the second method of the replication is where the ETF invests in financial derivatives such as swaps and access products such as participatory notes. So with the aim to produce the performance of the index. So in other words, these synthetic ETFs do not directly own assets in the index, and hence investor might be exposed to greater counterparty risk or greater tracking error. This type of structure is actually more common to track indices on restricted markets, or it cannot be directly replicated, such as buying barrels of crude oil or other commodities. You can usually find this information in the product highlight sheets or the prospectus of the ETF. Usually, I will refer to our website on the product landing page for a quick reference shown on the right. Right over at the overview of the ETF, we will indicate whether it is a synthetic or a physical ETF. So, after understanding the difference between all the exchange-traded funds, let me just share with you how to incorporate them into your portfolio. But before you start, it's important to actually understand your risk profile. So before you start, it's actually important to understand your risk profile and to know that there's actually a risk to reward differences. So factors like your risk tolerance, investment time horizon, goals would narrow down the type of investment products you should consider. On our website, we have this investor profiling questionnaire. You can fill it up and it will recommend you the risk profile based on your unique response to the questions. So say for instance, you are a balanced investor. And in a neutral asset allocation, we will allocate half in bonds and remaining half in equities. So a 50-50% portfolio. Within this broad asset class allocation, you can first build a core portfolio consisting of bonds and equities. This gives your portfolio the foundation to generate steady performance that does not require much monitoring or adjustment. So this core portfolio will represent the main bulk of your investments that should help you to achieve your investment objectives. So, for instance, under the core bonds portfolio, it can be made up of bonds in different regions. There are different, if you do have investment constraint, you can consider starting off with a global bonds portfolio first and gradually add in like Singapore corporate bonds and other higher yielding bonds into the asset mix. So this list of ETF you see here is taken from FSM1's very own ETF focus list, which I will share more later. So within the equity asset allocation, you can invest in broader equity markets like the global, US, emerging markets, Asia, Europe, etc. So without placing any emphasis on any single industry or sector, these equities will give you a highly diversified exposure to all the different markets. So should there be investment constraint and you cannot incorporate every single one of these ETFs into your portfolio, you can start off with first a global ETF, followed by an Asian equity fund or other EM funds. And subsequently, you can slowly add in other regional markets down the road. So once you have settled and gotten the core portfolio in place, you can afford to take slightly higher risk. So this is where the supplementary portfolio comes into the picture. The role of this portfolio would act as a kicker to boost your investment returns. And as these are tactical ideas, they could be either a single stock or other thematic trends that you have very, very high conviction of. You can express your best bets in this portfolio. And we will recommend to keep this allocation to less than 20% of the equities exposure. This is because ETF in this supplementary portfolio comes with an added element of risks. And they are typically less diversified and highly concentrated in single industry or markets. So should there be any unforeseen social, economical, or geopolitical changes that in that specific industry, these funds may suffer prolonged market weaknesses. And if you have added significant weightage into these tactical ideas, it could adversely impact your overall investment returns and derail you from achieving your investment goals. So, to sum it up, by adopting a core and supplementary portfolio concept in constructing your portfolio would help to minimize risk through diversification and in the long run, achieve above average returns with below average risks. So with so many ETF choices, we have also done the homework for you and selected a list of ETF which should serve as a good starting point to your investment decision. This list is refreshed every year, and the funds are selected based on several qualitative and quantitative factors, which my colleague Hui Shi will share more on later. If you have downloaded our FSM mobile app, you can easily access this ETF focus list under this ETF icon on our app. So our latest investment insights can also be found on the research tab. And also, if you do have Telegram, you can join our FSM1 research channel and get up-to-date investment ideas in bullet point forms, so you will never miss out on any of our investment calls. On our platform, we also have an ETF selector, which helps you to narrow down the list if you have a specific sector or parameters for your search. So, for example, you can shortlist this tech ETF listed in a specific exchange, or you can search via like payment methods to see which are the SRS or CPF approved ETF on SGX. So after populating the search results, you can click on these ETF individually and it will lead you to the product landing page on our website. There are a few actionable buttons where you can explore, such as like adding it to your watch list or set a price alert. Yeah, so the price alert will come in as an in-app notification, so you'll never miss out if the ETF hits a price that you're looking at. So sometimes for a quick overview of the top 10 holdings in the ETF, I would also view the details under the investment info tab. So let me show you over on the next slide. So under this investment info tab, you can see the top few holdings of the fund. It shows you what is the minimum investment lot size, the fees, and also the dividend info. So on the topic of dividends info, if you are invested in a US listed ETF or stock and you are not a US citizen, you will be required to pay the withholding tax. Capital gain tax will not be applicable since we are not US citizens. So for Singaporeans, because we do not have tax treaty with US, our withholding tax is 30%. So this means that if you are entitled to a dividends worth $100, you will only receive $70 net of paying the tax. So lastly, as markets do not go up in a straight line, investing via a regular savings plans allow you to do a dollar cost average and smoothen out the overall portfolio returns over time. We have 62 ETFs available on our platform to do our RSP, including tactical plays into Chinese tech, global financial, semiconductors, and even the ARK Invest suite of ETFs like your ARKG, ARKK, ARKF. And these minimum investment amounts starts from just 50 Sing dollar a month, and there's no minimum commitment period. You can terminate and stop the investment anytime with no penalties. So currently, we are running a promotion whereby the ETF subscription fee is waived to the end of the year. Personally, I've started a few ETF RSP as this promotion is way too attractive to be missed. So I hope that everyone found this short session insightful. So feel free to reach us out if you have any questions or type your questions in the Q&A box below. I'll hand over the time now to Geraldine. Yeah.
Thank you, Catherine. We'll now proceed to our next presentation. Yo Hui Shi, Equity Analyst, Stocks and ETFs Research, IFA Singapore, will be sharing with everyone on FSM1's ETF focus list around the world and different sectors with 50 plus ETFs. For those who are daunted by the sheer amounts of ETFs available, FSM1 has helped to highlight the best-in-class ETFs with the ETF focus list. In this session, Hui Shi will share about how we can pick the best ETFs and the latest changes to the list. Hui Shi, please.
Good morning, everyone. My name is Hui Shi. I'm an equity analyst from the Stocks and ETFs research team. And I'm here today to take you around the world and different sectors with more than 50 ETFs from our ETF focus list. But before we begin the journey, there are a few things that you as an investor first need to know. So first of all, there are many different types of ETFs available on the market for you to choose from. And after knowing what your choices are, I'm going to show you a few factors that you should consider when you are choosing an ETF to invest in. And last but not least, I'll be sharing with you our ETF focus list, which is a list consisting of 51 best-in-class ETFs across various markets and sectors that can guide you through your investment journey. So without further ado, let's start with the types of ETFs. ETFs allow us to reach every corner of the market, and this table here summarizes the most common types of ETFs. Equity ETFs, they can track either an equity market, such as Singapore, or a particular industry, such as the US semiconductor industry. Fixed income ETFs, they track the bond market, which consists of corporate bonds and government bonds. Commodities ETF, they can track the price of a commodity, such as gold or crude oil. Other than that, there are also smart beta ETFs, as well as leverage and inverse ETFs. Currently on our platform, there are over 3,000 ETFs from various exchanges for you to choose from. And with so many different options, choosing the right ETF could be an overwhelming task, especially if you are a new investor. Not all ETFs are made equal, and so I would like to share with you a few factors that you should consider when selecting an ETF to invest in. And this is also the selection methodology that we have used to select all the recommended ETFs in our ETF focus list. So when choosing an ETF, we consider both the quantitative factors and the qualitative factors. So firstly, under the quantitative factors, we consider the tracking difference, expense ratio, and liquidity. ETFs, they track an underlying index, and the first quantitative factor, tracking difference, this is the difference between an ETF's performance and the performance of its underlying index. Tracking difference is usually negative, which is in the case of this diagram here, as the ETF's performance, which is denoted by the red line, is slightly below the performance of its underlying index, which is denoted by the gray line. There will always be a tracking difference, and this is due to many different contributors, such as expense ratio, rebalancing costs, currency hedging costs, securities lending, so on and so forth. And if an ETF has a smaller tracking difference, this would mean that its performance is closer to the performance of its underlying index. And hence, we prefer ETFs that have a smaller tracking difference, as the primary objective of ETFs is just to simply replicate the performance of its underlying index. And the next quantitative factor to consider when selecting an ETF is the expense ratio. Expense ratio is expressed as a percentage of an ETF's average net assets. This is the annual cost that investors have to pay to cover for the ETF's operating expenses and management fees. And I have a table here that illustrates how the expense ratio can affect your investment returns. Let's assume that you put an initial investment amount of $10,000 in one ETF over a period of 5 years. And this ETF is able to generate an annual return of 10%. If the ETF that you invest in has an expense ratio of 0.5%, at the end of 5 years, you will find that your investment will be worth around $15,700. And this is after more than $300 has been deducted off because of the expense ratio. And hence, the expense ratio's impact on your returns after 5 years is actually around -2%. And you may notice that the higher the expense ratio, the greater the impact on your returns. And even a small difference in expense ratio can significantly lower your returns over the long run because of the compounding effect. And this is also why we prefer ETFs that have a smaller expense ratio, as assuming that everything else is equal, the lower your cost, the higher your net returns. And the last quantitative factor to consider is liquidity. Liquidity, it refers to how easy it is to buy or sell an ETF quickly without affecting its price. And unlike stocks, ETFs, they have 2 layers of liquidity, namely the primary liquidity and the secondary liquidity. So firstly, primary liquidity, this is determined by the liquidity of an ETF's underlying securities. One key feature of ETFs is that they are open-ended investments, so that they can always be created or redeemed whenever there is excess demand or supply in the market. But for retail investors who do not buy or sell tens of thousands of ETF shares, secondary liquidity will be more relevant for you. The secondary liquidity is determined by the volume of actual ETF shares traded. And this is also called the on-screen liquidity, which are your trading volume and beta spread. We prefer ETFs that are more liquid, which also means that they should have a higher average trading volume as well as a smaller beta spread. And so this will sum up all the quantitative factors. Now we'll move on to the qualitative factors, which are the choice of index and the structure of the ETF. So when choosing an ETF, it is important for you to know what you are getting yourself into. So you should be able to understand the index that the ETF is tracking. And the underlying index, it has to be a good representation of the market or the sector that the ETF intends to track. And knowing the top 10 holdings of an ETF will be useful as well, as it will be a good gauge of the ETF's underlying exposure. And you can visit the ETF fact sheet on our platform to view an ETF's top 25 holdings, as shown in this screenshot here. The next and final qualitative factor to look at is the structure of the ETF. An ETF can have either a physical or a synthetic structure. But majority of the ETFs out there, they are physical, which also means that they hold the actual underlying securities that make up the index that it is tracking. If the ETF holds all the underlying securities in the index, we call this a full replication. And if the ETF holds only a sample of the index, this is called a partial replication or representative sampling. Partial replication is usually used when there are liquidity issues or when there are thousands of holdings in the index, making full replication very difficult and costly for the ETF manager. So other than physical ETFs, there are also synthetic ETFs. Synthetic ETFs, they do not hold the actual underlying securities. Instead, they rely on derivatives such as swaps to execute its investment strategy. And this allows investors to gain exposure to illiquid and hard-to-access markets, such as commodities. And one point to take note is that as synthetic ETFs, they use derivatives, investors are actually exposed to counterparty risk. And we generally prefer physical ETFs, which has limited counterparty risk. And so this will sum up all the factors that you should consider when you are selecting an ETF. And this is also how we have selected all the recommended ETFs in our ETF focus list. So for the quantitative factors, consider the tracking difference, expense ratio, and liquidity. And for the qualitative factors, consider the choice of index as well as the structure of the ETF. And now I will show you a simple example of how we actually apply this selection methodology to our ETF focus list. Let's say we want to select the best ETF that tracks the Singapore stock market. The very first step will be to screen out all ETFs that track the Singapore economy, and then pull out all the relevant data, which are the 3 quantitative factors I've shared earlier: expense ratio, liquidity, and tracking difference. A score is then given to each factor as shown below. So the better the ETF has performed in each factor, the higher the score it will receive. For example, an ETF with a lower expense ratio will be given a higher score under this factor. We also assign a weightage to each factor based on their relative importance. And from here, a total score is then calculated for each ETF. And the ETFs are ranked based on their total score. We will then proceed to look at the qualitative factors, such as the choice of index and the structure of the ETF before making our final decision. In this example, it is simple. After considering the qualitative factors, we have chosen the SPDR STI ETF as our recommended ETF for Singapore in our ETF focus list. So I hope now you have a better idea of how we have selected all the ETFs for our ETF focus list. And finally, we have reached the highlight of my presentation, which is on the latest edition of our ETF focus list. So to give you some background, we understand that there are many ETFs listed across various exchanges for you to choose from. And in fact, there are over 3,000 of them on our platform right now. And to help guide investors on their investment journey, we first introduced our ETF focus list in 2018. We have done all the heavy lifting for you. We sift through thousands of ETFs and then identified the best-in-class ETFs in our ETF focus list. And to ensure that our recommendations remain current and relevant for our investors, we have updated this list on an annual basis. So this year, it is no exception. We have made a couple of changes to the list in order to feature a wider range of ETFs that the world has to offer. So now this year, our ETF focus list consists of a total of 51 ETFs that provides you with exposure to various markets and sectors and can hopefully guide you through your investment journey. So now I'll be sharing with you the major changes that we have made to the ETF focus list this year. The very first major change is that we now have a new recommended ETF for China. Our previous recommended ETF, which was the Vanguard Total China ETF, has been delisted as Vanguard exits the Hong Kong market. Given its delisting, our new recommended ETF for China is now the iShares Core MSCI China ETF, listed on Hong Kong under the ticker 2801. It provides a good exposure to China. It tracks the MSCI China Index, which features large and mid-cap companies listed in mainland China, as well as outside of mainland China. And the key difference to note about this MSCI China Index is that it has a higher weightage to the H shares and ADRs and a lower weightage to A shares. And while the MSCI China Index may be different, it is still a good representation of the Chinese economy as it provides exposure to Chinese companies listed across various exchanges. And after considering quantitative factors such as liquidity and expense ratio, we believe that the iShares Core MSCI China ETF is the next best China ETF available on the market right now. And in last year's edition of our ETF focus list, we had 3 different ETFs for investors to gain exposure to China. There was 1 ETF each for China A share, China H share, as well as Total China. As our new recommended ETF 2801 already has a decent exposure to the H shares market, we have made the decision to merge the China H share and the Total China subcategories into the new China subcategory. So the choices for investors have been narrowed down to just 2 ETFs now. For a diversified exposure to Chinese companies, regardless of the country of listing, our recommended ETF is now the iShares Core MSCI China ETF 2801. And if you'd like to have a pure play exposure to onshore Chinese companies, our recommended ETF for the China A-share market remains the same, which is the iShares FTSE China A50 ETF 2823. And apart from our new recommended ETF for China's equity market, another major change that we have made is that we have added China government-centric into the fixed income category. China's government bonds, they offer much higher yields as compared to similar term-note government bonds issued by the developed economies. And this is keeping in mind that China has a sovereign credit rating of A+ by S&P. Apart from its high yields, Chinese government bonds also have a low correlation with other fixed income markets, and hence they can provide diversification benefits to any global fixed income portfolio. So with their decent yields and low correlation with global bonds, we believe that an allocation to onshore Chinese government bonds has become increasingly compelling. Our recommended ETF for investors is therefore the ICBC CSOC FTSE Chinese Government Bond Index ETF, listed on SGX under the ticker CYB. Other major changes to the list this year includes our new recommended ETF for India under the single market category. The iShares MSCI India ETF, which is listed on BETS under the ticker INDA, has replaced our previous recommended ETF, which is a similar ETF listed on SGX. And the rationale behind this change is because our new recommended ETF, INDA, has higher liquidity as well as an expense ratio of 0.69%, which is much lower than the 1% being charged by our previous recommended ETF. And last but not least, we have made a couple of exciting additions into the tactical plays category. This category features some of our favorite investment ideas. And the first addition is the China real estate subcategory. China's growing urbanization rate is expected to support the demand for housing, and investors who are keen to invest in this sector can consider our recommended ETF, which is the Global X MSCI China Real Estate ETF, designed to provide exposure to large and mid-cap Chinese real estate companies. The second addition is China Semiconductors. This sector is about to enter a phase of supercharged growth as China doubles down on efforts in building up its very own semiconductor industry. Our recommended ETF is the Global X China Semiconductor ETF, which provides exposure to semiconductor firms listed in mainland China. The third addition is into the tactical plays category is digital payments. As the world shifts towards a cashless society, there is great momentum for the further adoption of digital payment systems. Our recommended ETF is the ETF MG Prime Mobile Payments ETF, tracking the performance of the mobile and digital payments industry. And some of its key holdings are card networks such as Visa and MasterCard. The fourth, which is also the last addition into our tactical plays category this year, is none other than the US banks. With rising inflation rate hikes, they may be put forward, and this acts a major catalyst for the US banks' profitability. Our recommended ETF is the Invesco KBW Bank ETF. And so this will sum up all of the changes that we have made to our ETF focus list this year. And to view the full list of ETFs in our ETF focus list, please visit our FSM1 homepage and then go to the ETFs or the Research tab and click on ETF Focus List. Our ETF Focus List is also available on our FSM1 mobile app. You will then arrive at this page, and to navigate, you can switch between the 6 different categories that we offer, which are core equity, fixed income, regional equity, single market equity, commodity, as well as tactical plays. All in all, our ETF focus list, it serves as a good starting point for investors who are seeking diversified exposure to markets at a low cost, as the list helps you to zero in on the best-in-class ETFs. And you may notice that there are some ETFs from last year, such as the China H share ETF. It was not in this year's focus list, but if you're holding on to them, do not worry. They are still viable investment options for your portfolio, as they were merely beaten by a hair's breadth by a fellow peer. And like all the other ETFs in our ETF focus list, they will continue to be available under our ETF RSP list. And with that, I have come to the end of my presentation. So do check out our ETF focus list. I'll now hand the time back to our MC.
Thank you, Hui Shi. We'll now proceed to our first quiz of the day. 3 winners with the most accurate and fastest answers will walk away, or rather fly away, with 3 units of the ETF MG Travel Tech ETF each. To access the quiz, you'll need to be on Event Live. Click on Event Activities on the black menu below the video window. Under the agenda, click on Quiz number 1. Click on the Join Quiz button, and the activity window will be displayed on your right. And once the quiz ends, a leaderboard will be displayed, and you may check if you're one of our winners. So on the Event Live page, look to the right side where it says Quiz, click on it, and we will start with a trial question. I hope everyone has been able to access the quiz. And when you're ready, we'll begin. So warm-up question 1, FSM ETF Festival is organized by... Keep in mind that we're looking for the fastest and most accurate answer. I'm sure we all know this one. Good job. The answer is fsm1.com. And now let's get ready for question number 1. Question 1. Which of the following is not available on fsm1.com? The answer is option 3, Automated ETF Recommendation. If you didn't get this one correct, it's okay, because question number 2 is coming right up. Question 2, which one of the 4 destinations is not recommended by our macro analyst? Is it emerging markets, US, China, or Europe? And the answer is option 2, US. Again, it's okay if you didn't get this one right. You have 3 more chances to go. Question 3. The ETF focus list serves as That's a tricky one. The answer is option 4, a starting point for investors who are seeking to invest with ETFs. That is okay, because the next question is coming up. Question 4, which of the following is not a criteria used to select the ETF in the ETF focus list? Risk-adjusted returns, tracking difference, expense ratio, or liquidity? We're looking for the fastest and most accurate answer, so despite being fast, you have to be the most accurate as well. And the answer is option 1. Question number 5. The minimum investment amount when investing via ETF RSP is it $1,000? Is there no minimum? Is it 1 unit of the ETF? Or is it $50? I believe Catherine went through this during her session. And the answer is option 4, $50. Good job to 74% of you. It's okay if you didn't do so good this time round because we have 2 more quizzes coming up throughout today. But good job to the top 3. So who are our lucky winners? If your results screen show rank 1, 2 or 3, you must take a screenshot showing the whole activity window right now and make sure that your rank, score and nickname are captured clearly. Then email the screenshot and also include your name, FSM account number and daily quiz date to events@fundsupermart.com by 21st May to claim your prize. And that's it for our first segment, the pre-flight checklist. With helpful tips and guides by our speakers, we hope all your viewers are more prepared and confident to start their ETF investment journey. And we will now head for a lunch break, and the broadcast will resume at 12:30 p.m. right here as we head in the in-flight segment. If you have any questions regarding the presentations today, leave them in the Q&A section and we'll have our speakers address these questions later today. Before we head off for lunch, do check out the promotions FSM1.com is running today. Receive 3,000 rewards points by opening a new FSM1 account. Already have an account? Refer a friend to open an account and both of you could receive 3,000 rewards points. The promo code to use is TakeFlight with FSM1. From now till the 31st of May, enjoy 2 free trades on ETFs in the 2021 edition of the ETF Focus List. The ETF Focus List, put together by FSM1.com, offers investors a starting point by identifying the best in-class ETFs. Check out the new additions to the list. And for more details, refer to the promotional article on FSM1.com. From now till December, FSM1.com is offering 0% processing fees on ETF RSP. Pick from a wide range of over 60 ETFs listed on the SGX, Hong Kong, and US exchanges. With ETF RSP, you can start growing your investment portfolio on a regular basis with as little as $50 a month. Also, don't forget to accumulate chances for the lucky draw held today, where 5 lucky participants will walk away with $100 worth of Chris Shop vouchers, and 1 lucky winner will receive the grand prize of $880 worth of FSM1 multi-currency cash account credits. You can accumulate your chances by logging in. You can also accumulate your chances by participating in the quiz sessions. You can also accumulate chances by completing and submitting the survey today, or by visiting our partners pages and by sharing this event on your social media through the social media buttons on the footer. Be sure to join us again for even more exciting presentations starting at 12:30 p.m. and we'll see you later.